How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to take a look at real estate concentration, specifically commercial real estate. And, is having a concentration of commercial real estate in your loan portfolio, is that necessarily a bad thing? Banks have certain ratios like the 100 and the 300 ratio, which basically they analyze all the time to see if you have this really strong concentration of commercial real estate. Many banks around the country could be considered to have a concentration in commercial real estate. Now, and I think the question there is that really as bad as it might sound? And I think it really depends. I think it depends on what the niche is of the bank. Are you really good at that particular niche? In other words, some banks are really good at managing and financing construction loans. They love to do ground up construction, whether it be on an industrial property or maybe it would be considered what's called tract home development. Maybe a Pulte Homes wants to come in and build 500 townhouses. And, some banks are really good at that. Other banks like the more vanilla stuff. They like, they want what are considered stabilized properties. They want the warehouse that's already built, already has a tenant in it, is performing great, has strong cash flow. That's the kind of stuff they want to finance. Or there's an existing business owner that wants to buy a building and needs the building for their business, and they're very comfortable with the business. The business has been around a long time, has a strong history, strong cash flow, strong earnings. The owners of the business look really strong and healthy financially. That kind of thing. So, but then there's also other banks, as the example we're about to look at here in a second, of this particular bank had a niche in financing mobile home parks, and was that really a bad thing? So let's jump into this. So I saw this article here, and this was basically capitalizing on disruption, California's entrepreneurial Five Star Bancorp. Now, Five Star Bancorp, as you're going to see in a minute here, is a very high performing bank. They have some outstanding financial numbers and results that they have been able to achieve over the years. But they've got this niche in their portfolio, again, with this mobile home parks. That caused the regulators some consternation when they wanted to kind of move into a new area out in California. Now, we're not going to examine every part of this article, because part of the article talks about the technology that they use and all this kind of stuff. But I really like the part about the commercial real estate and how that plays in. So let's jump into this, for example. So James Beckwith, who's the CEO of Five Star Bancorp, is always looking for opportunities to grow his $3.6 billion Rancho Cordova, California-based franchise. So a decade ago, he stumbled across a profitable niche financing manufactured housing parks that has turned into a core growth engine. Five Star also made hay during the pandemic, originating loans under the federal government's PPP program when small business owners couldn't get bigger banks to pick up the phone. For a while, one long-term goal seemed unattainable: setting up shop in the San Francisco Bay Area. The company's stated goal is to be the preeminent bank in Northern California, and that's tough to do without a Bay Area presence. But how could a small bank from suburban Sacramento gain a foothold? Realistically, how would we get someone from one of the banks there to say, yeah, let's leave our current situation and join Five Star Bank, Beckwith says. Then March 2023 happened. Silicon Valley Bank collapsed over liquidity concerns, followed quickly by Signature Bank and then First Republic Bank, all institutions with large presences in the Bay Area. Suddenly, there was a lot of disruption, customers, and a lot of really good bankers in the market who didn't have a horse to ride. It's kind of an interesting phrase. I like that. Beckwith recalls, we were ready to respond quickly. So less than 3 months later, a team of 5 former Signature bankers signed on as initial building blocks in what has become a full-out assault on the Bay Area banking market. Five Star now has 20 business development officers, or BDOs, working the metropolitan area's small business community, most of them refugees from Signature or First Republic. The bank later this year will open a branch in downtown San Francisco. If there's one thing we've tried to be consistent about over time, it's being opportunistic and taking advantage of market displacements, Beckwith says. So then it goes on to say, basically, the 25-year-old company is defined and differentiated by what it does and how it does it. Like a powerhouse lending niche in manufactured housing provides much of its earnings oomph with relatively low risk. Equally important is a culture that is centered firmly on customers and grounded in immediacy and purpose. Five Star's incentive scheme doesn't cap how much its bankers can make, inspiring them to produce. A laser focus on credit quality and an engaged board minimize the downside risks and further drive growth. Most important might be its ability to quickly capitalize on opportunities. So now it gets into, Five Star reported a return on average assets in 2023 of 1.44%, pretty good, and a return on average equity of 17.91%. Both figures among the top 50 for all public banks. Absolutely fantastic numbers. That return on equity is a fantastic number. Now we get into the CRE concentrations. As for many community banks, attracts scrutiny. Fully 86.8% of Five Star's loan portfolio at the end of 2023 was tied to CRE, valued at 682.7% of its risk-based capital, according to company filings. That was well beyond the regulatory guidance subjecting banks with CRE loans of more than 300% of risk-based capital to greater supervisory scrutiny. At a time of gloom and doom around the sector, such exposures could spark worry. The biggest concern I hear from investors is, how does this play out over time in terms of CRE concentrations, says Andrew Terrell, a managing director at Stephens. There's a lot of angst about CRE. So let's take a step back for a second here. So their CRE portfolio is at 682%, whereas the regulatory guidance is 300%. So they are double. They are more than double what the regulatory guidance is in terms of their concentration in their loan portfolio. So, and I should say at this point that you have these numbers. You have 100 and 300. So 100 really looks at like 100% is really focusing on like construction loans, like land loans, construction loans, things that are basically classified as what is the classification? High volatility, HVCRE, high volatility commercial real estate. So like I said, land loans, construction financing, construction projects that are in the works. That basically makes up comes up to your 100 ratio. And then just the overall portfolio, like how much commercial real estate do you have in your overall portfolio? That's what comes up to the 300%. Now, again, you have to understand that those numbers are just guidelines. They're not like hard and fast rules. The bank can't necessarily get in trouble if they're over those guidelines. It's just that, your regulators might come in and basically be like, whoa, you got some serious concentrations going on here. Are you sure you don't want to maybe try to diversify this a little bit more? So, you're definitely going to have those conversations when they come in to take a look, but let's keep going here a little bit. I'm just trying to give everybody a little bit more background here on some of this stuff. So judging by the numbers, however, credit quality on the 2.69 billion CRE portfolio hasn't been an issue. Non-performing loans at the end of 2023 accounted for just 0.06% of loans and other real estate owned, among the lowest in bank directors' rankings. So just to give you a little bit of perspective on that, I would say kind of the industry standard is like 1%. If you have 1% delinquency on your portfolio, that's probably giving you some concern. If you're seeing 1%, it's kind of like, hey, what's going on there? Certainly if it's over 1%, it's like, hey, what now? Let's really take a look. What's really going on there? But I think most banks, if you're hanging around at like maybe 0.75, or if you're 0.50, it might spur a few questions. Hey, did you have a big write-off? Did something go bad? What's going on there? But if you're below 0.50, if you're 0.25, 0.3, 0.5, that's all pretty strong, pretty good numbers for the industry. So obviously having a 0.06 is an outstanding number. So, if you just pulled up, and then it goes on to say, if you just pulled up our call report, you'd be like, yikes, they are seriously concentrated in CRE, admits Heather Luck, Five Star's chief financial officer. But it's all about how we manage the program and the granularity of the loans. And it goes on to say a unique niche. To understand what drives Five Star's success in CRE, look first at the portfolio's composition. Office loans account for just 5% of CRE loans and are mostly for 2 or 3-story suburban office buildings, not downtown high-rises. Some targeted customer niches, including faith-based communities, multifamily, industrial, and mini storage facilities, each generate about 7% of the company's CRE loans. Most of the rest, a whopping 44% of the entire CRE portfolio, are loans to manufactured home communities and RV parks. The borrowers are professional park operators, not people who own mobile homes. Most of those firms own dozens, if not hundreds, of small housing communities that charge homeowners, ranging from retirees to two-income families who typically pay between $100,000 and $200,000 for their abodes, $500 or $600 per month in rent for the space and hookups. In total, there are about 44,000 such communities around the country, most of them mom and pop shops, and the space is consolidating rapidly. Five Star picks its clients carefully, working only with experienced park operators. A typical loan might be $2 million to finance the acquisition of a park or upgrade its utilities or pavement so the operators can charge a bit more in rent. The credit quality is superb, Beckwith says. The data is easy to track and digest. To add comfort, Five Star's team re-underwrites every park loan worth more than $2 million annually and performs regular site inspections. It's also a national business. 42% of the manufactured housing park portfolio comes from outside of California, providing valuable geographic diversification. So CRE is the lifeblood of most community banks. It's how you diversify inside CRE that matters, says Robert Perry Smith, Five Star's chairman and a longtime accountant to the banking industry. We believe there is a high degree of safety in mobile home communities. If everything goes to heck in a handbasket, people still need a place to live, and this is pretty affordable. So by all accounts, regulators understand the portfolio's dynamics well enough to approve. They've taken a lot of time educating regulators on the types of loans they're underwriting, Terrell says, and it appears to have worked. It seems like there's a lot of regulatory support for them being at the level they're at as opposed to pushing them lower. So again, this gets really interesting when you take a look at it. So in other words, this is a bank that's been doing this for a while. They're not new to this. They didn't start doing this 5 minutes ago. This is their niche. This is what they really work on, and this is their home run hitter, so to speak. And they're very good at it. They're very good at it. The people that they're working with are probably very well heeled. Highly experienced operators that have obviously like own, a certain number of these type of operations. So, you're dealing with highly qualified professional people that know what they're doing, that have been doing this a long time. They seem like they have a very good underwriting game plan for how they look at these things, how they evaluate them. That's a great mix. That's a great mix in there of how they do this. So it gets back to the question here. Just because you're concentrated in real estate doesn't mean that has to be a bad thing. It all depends on what the niche is and how you're doing it, how you're working it. In the episode that I did yesterday, I did kind of an update on mergers and acquisitions, and I talked about a recent transaction that was just announced between two banks here in Pennsylvania, Traditions and ACNB. And the problem with Traditions Bank in that situation was that they were basically a mortgage shop, and interest rates had really hurt their business because the refinance boom was over. People weren't buying houses because they couldn't afford them because the interest rates went up. So that really hurt their earnings. And at the same time, deposit rates went up. So they got they really had some serious margin compression, hurt their earnings, had an earnings squeeze. But when you look at their portfolio, though, I mean, they were all residential mortgages. So and that was their niche. That was their profession. Did they have a lot of loan delinquency? No, they didn't have much delinquency on their portfolio. So the underwriting was good. The underwriting was sound. It was just the market dynamics that had hurt their operations. So again, you kind of go back to the market niche. What's the market niche? How are you doing it? Then the article basically goes into talk, we kind of fell into this business, and that the bank was born for CRE. So the bank was, founded in 1999 by a pair of real estate professionals. And then it goes on, kind of work hard, play hard. And they get into how they also invest in technology and go through that. So they believe in the San Francisco market. But really, really good article here. I thought this was great at basically showing the fact that just because you have a concentration in real estate, maybe your bank's portfolio might be well over that 300% threshold ratio number. It's fine. It's fine. It doesn't, that's not a death knell. It doesn't mean you're running a bad bank. Doesn't mean you're going to have all kinds of problems. But it gets back to also, what is the performance? And how do you tell the story? How do you tell the story of your bank? How do you tell that story to investors when investors call up and say, yo, you guys got a serious concentration problem here? So how do you sell that story to investors? How do you sell that story to regulators? How do you sell that story to potential customers? It's all about that communication, how you sell that at the end of the day. And is that strategy, is that niche really working? If it is, hey, keep rolling with it. It's like I've said it all the time. I think more companies get in trouble trying to be either all things to all people, or they get in trouble, try to get into some new product line, which is just something that they're just not. That's not who they are. And I say it all the time, there's nothing wrong with just making a dollar at what you're good at. Just having a niche, having a specialty in something, and just working it every day and just making that dollar every single day. There's nothing wrong with that. That has led to many a great business over thousands of years, and it's a principle that will stay true for thousands more. So anyway, so I hope you found this article. I hope you found this a little interesting today. So I will wrap up with basically, if you like this episode, please make sure to like, share, and subscribe, as that helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Don't forget, tomorrow night, BND Strategy Room live stream, 7 o'clock on YouTube. Hope you'll be there. Hope you'll check it out. And definitely more content will be in the works for this coming weekend and for next week coming up. So I hope everybody will go back and check it out. But I will see everybody again real soon. Thank you so much.